How much is too much? That's what we're going to break down today. What a day. Let's go ahead and get started. Today is Wednesday, October the 10th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. What a day to find us. Keep coming back for more. Subscribe to our YouTube channel. Hit that logo right here in the bottom right corner. Click the red subscribe button that pops out. This has been an interesting day to see what's going to happen tomorrow. For us to do these videos, we would really like to see those likes, those thumbs ups down below. So click that thumbs up if you want us to do another video like this tomorrow, the day after that, and going forward. A really easy way to give us feedback. I want to see your comments down below. This should be a day we get a lot of comments down in the comment section. Follow me on Twitter. I posted a lot of stuff on Twitter today. Make sure you check that stuff out. Follow me there and join our community on MarketScholars.com as well as our Market Outlook community on Facebook. You can do both of those for free. All right, well, let's take a look at what's going on today with the market forecast indicator right off the bat. And you can see, as bearish as it was, pulling down right to that 27, well, finishing today at 27.85, right at that 62% Fibonacci retracement, right at these old high points. So right around this 2800 level. That's the bottom end of this Fibonacci retracement area of the rally off of 2700. So we went from 2700 up to 2950. So probably about, what, 8% or so rally. And then now coming down. All right, now coming down to Fibonacci retracement and really dropping significantly. In fact, if you take a look at the weekly chart, you can see the last time the momentum line got as low as it is. Now, granted, there's still a day left in this weekly candle, so keep that in mind. But the last time we had this far of a weekly pullback was right here. We dropped down to, let's see, right on this week, the week of March 19th. And you can see how big of a week that was. You can also see here we were way up above the 200-day moving average and we fell down. And then on this week here was kind of an end of week, really small range. You go back to over here. Here's another time that the weekly candle was very large to the downside. You can see we rallied off of that. You can see some other instances here of extreme bearishness over the course of a week from a market forecast perspective. So big move to the downside, and again, as bearish as today seems, as bearish as today was, it still didn't change the trend, right? When you define trends as higher highs, so here's one intermediate high, here's the current one, the one we're coming down from, the one before that was right here, right? And again, measured simply by the intermediate line. Higher highs, and as of right now would be a higher higher low point. Now granted, we'll see what happens tomorrow, but that would be a higher low point at current levels. That's still the trend. Now you break through this low point and things change, right? Because at that point, yeah, we'd still have higher highs, but we'd have lower lows. So you'd expect the next high to be lower too. So that's a big, that would be trend changing at that point. Regardless, the odds now of getting up to significant new highs on the next intermediate run would be down. Not down to zero, but would be lower simply because of how much we pull back today. Big extreme move. The intermediate line still below 50. Near-term line, you notice, did not drop below 20 yet. It did pull down, but is not extreme to the downside. The Dow itself still has not produced the dark pink shading, which is obviously it will by tomorrow, but barring a 1,000 point move to the upside tomorrow. Most likely you're going to get that falling off too. You can see the last time the momentum line on the Dow got this low point. I mean, this isn't as high of a beta as like the Russell 2000. So the last time we were this extreme to the downside was right here, June 27th. And before that was over here on April 30th. And you can see some other instances of extreme bearishness in the momentum line. Again, just on the daily chart here. The NASDAQ composite is at its old intermediate low point. So this is a significant drop. So here we were in Fibonacci retracement zone today, getting the oversold cluster, sitting on a potential trend changing support. So definitely something to keep an eye on. And you can see here as well the Russell 2000 is sitting at these levels, at this old high point over here, which is a 62% Fibonacci retracement of the current long-term run that we're on, second consecutive day of oversold clusters. So very oversold in these higher beta areas. The Dow finally catching up, or it really hadn't caught up yet, and the S&P 500 sitting on a very important support level itself in terms of how likely we are to bounce to new highs if we were to break these levels. So big breakdown. We broke down below this January high point, but that we were holding right around that 23% Fibonacci retracement today, and then you can see breaking below 2850. We were right around the 50% retracement for a while today, and then breaking by the end of the day down to the lows around 2800. All right, now things get a little interesting. You can see the drop below the 50-day moving average. Again, we had a very similar drop over here on this level. This is that week of that March 23rd. You'll see a lot of similarities to this week, to the week of March 23rd. We were also had a really high MACD. We were coming down from a really high MACD. Now, granted, we had already pulled back from that extreme levels above the 200-day moving average. Then we had bounced, and then the March 23rd, 22nd to the 23rd, those couple of days, we didn't drop. We dropped significantly below the 50, but did not get below the 200. Again, we're still a day away from this weekly candle ending, but so far we are still above the 200-day moving average. There's your Dow Jones Industrial Average. The NASDAQ Composite is sitting at its 200-day moving average, and the Russell is through it. Now, again, you remember, so here's that March 23rd week right there. It did not get below, but on this week over here, we did dip below before bouncing by the end of the week, and you can see other instances where we did get below the 200-day moving average before in 1 week and then bouncing. So we'll see, considering all the others are still above their 200-day moving average, we'll see if that pattern holds true for the Russell, or if we end up holding this breakdown on the Russell through. Remember, it's at an important support level right at this area here that we were looking at before on the daily chart. If you look at the 3 green arrows, you can see obviously on the S&P we're at 3 red arrows here. And just to kind of give you an idea, let's go to the 2-line version. There's the 2-line versions, and you can see the MACD and stochastics and what they're doing. But what I want to show you here is, let's take a look at that let's get rid of the stochastics and just look at the MACD. But I want to take a look at how far down below the 8-day moving average we are. And you can see that's the blue line right here. So we are further below the 8-day moving average. The last time we were this low was March 23rd. So again, another comparison to that week that ended on March 23rd. See, this was March 22nd. That was a Thursday. Then we had another down day on March 23rd. So you can see some comparisons here. Of course, over here, when we were so far up above it, we had above the 200-day moving average, right? We really pulled back down, and some really crazy moves on that side, breaking below support, and the VIX spiking up to 50. We haven't seen that yet. We just barely got above 20 on this level. But it kind of gives you an idea of how extremely oversold we are and how hard it is to stay down this far, because it attracts a lot of people that are looking for some really good buying opportunities at these really, really low, these rare low levels as far down as we've been. You can see below the 30-day moving average, that 6-week moving average that we have, kind of an intermediate level there, and that's actually a simple moving average. So let's change that to simple. Here you can see again, we haven't been this far down since this March 23rd, or actually here March 23rd, and then that subsequent April 2nd kind of double bottom there. Again, it's kind of hard to extend itself too much further away from that, from those levels, because of how far we already are, and people start looking for some value, some opportunities. So that's what I wanted to show you on the MACD. Again, when we get when we get these moves to the downside that are pretty steady, then that means that's actually more bearish than when you get a flush, when you get one big extreme move to the downside that just takes everybody out, and then value buyers start coming back in, right? Value opportunities, looking at these really sold off stocks, and a lot of them have been, and that's the article I tweeted out. A lot of these stocks in the S&P 500, even if the index itself has been holding up, a lot of issues within the S&P have already pulled back 10%, 20% from their all-time highs. So there already is a lot of value opportunity in some of these areas that have been stealthily setting up in the background while the market's been kind of waiting for the broad index to fall. When you look at the intraday chart, I mean, we obviously have a new low point that's probably going to be set there on the 4-week basis for a long time. There's the open for the candle, so we're not going to get above that open anytime soon. There's the midpoint now for the current 4-week range, and that will stay there, barring a new low, but the new high won't come down for a while either. It will come a little bit down to this level, to last week's high point, but that's going to be up there for a while. It's just a matter of how much wider this already, 15-point spread in the 4-week range already is. So it's about a 5% spread between the high and the low at current level, at the high point, at the level of the high point. So when you look at the volume for today and the trading range for today, here let's go to obviously lower high, lower low, and all that jazz. I mean, it's a bearish candle, pretty obvious to show there. Let's go to this chart and let's look at SPY over here. Here's where I talk about the extremes, right? A 9-point move, and the average right now is 2 points. I mean, that's an extreme, and that doesn't include the half a point gap that we had. So really, the range today, including overnight trading, is 9.5 points. And then you have the two, and it's actually coming down a little bit too in the after hours. SPY is down a couple more, about another $1.50 in the after hours, down a little bit more earlier. So, whoops, let's go back to the SPY on this chart. So a 9-point range, and you can see the volume hit 214 million. Just to kind of give you an idea, that's a 3 standard deviation move in volume. 210 on this level, on this chart. 200, that's a 3 standard deviation. That's an extreme level. Again, last time we were even close to 3 standard deviations was the week that ended March 23rd, and then the subsequent bounce there on March 29th, and then we rallied off of that. And of course, over here, these two big flushes got us over the level 2 and created the big bounces back up, and eventually back and move back up to 275, just like that. So you know, that was an extreme amount of volume. It was an extreme amount of extreme trading range. And then when you look at the volatility, the VIX, and you can see here, we'll just take a look at this chart. We jumped up to 22.5. It jumped up to over 1.1 today. We finished over 1.1. We don't get above 1.1 very often. Just to kind of give you an idea. The last time that we even got there on an intraday basis, so here, let's go back. Well, let's stay there on the closing basis. So the last time we were above 1.1 on a closing basis was, again, March 23rd. So again, another similarity to the week that ended March 23rd there in terms of a big kind of washout move to the downside. Then eventually we had a subsequent bounce. We stayed above 20 for another couple of weeks, but you can see from that level, we dropped. And you remember, similar to March 23rd, if you go back to the long-term chart, that week of March 23rd also went significantly below what was a pretty strong 50-day moving average, a gap between the 50 and the 200. We really filled in that gap pretty sharply. We're doing it again. Still have another day tomorrow, right? We still have another day, but we did it again today. Actually, we have 2 more days. Sorry, I don't know why today's Thursday. We have 2 more days in this week. And we could still fill in the rest of it just like we did there. For all we know, obviously we'd be breaking Fibonacci support if that happens, and we'd be breaking below these high points that we had. But we wouldn't be breaking below this intermediate low point yet if we were, because that is below the 200-day moving average. So there's a lot of similarities to how we ended that week on March 23rd. And you can see, including the volatility index and how much it spiked today. Here, let's go here, and how much it spiked on a relative basis. I mean, again, just even looking at it on an intraday basis, going back the last 6 months, we just don't get above 1 very often. And here's all the other times we got above 1 right there. We got above 1 right here. We got above 1 in the end of April. And then, of course, there's the last time we got above 1.1 on March 23rd. So before that, we hit above 1 at the end of March. And, of course, there's the big washout. So we don't have that kind of move yet. In fact, if you notice, we finished the day. We didn't finish the day just at 22 and a half, right? We finished the day at 33. So that's where we finished the worst day of all that selling. See, on February the 2nd, we moved. We went from 13 up to 17, but then we went from the next day from 17 up to 33, and then from 33 we actually stayed just over 30 there, and then of course we finally rallied about a few days later on volatility. But that was the worst, right? That was when we got up to 46, and you can kind of see what happened there. That's the worst case that it got to. It was the worst close. That was our worst daily close. It closed at 36 on February the 8th. So now you look at how we compare today. We went from 16 up to, not up to 33, right, up into this area. We went up to 22 and a half. We didn't get up to an extreme like we did over here, finishing the day at 1.28 after getting all the way up to almost 1.5 at the highest point for that average. We only got to 1.1, which we've been before just recently. So again, another sign, another very close similarity to what we saw at the end of March, and a opportunity for this extreme. When you get the extreme sell-offs all in one day, it's hard to sustain, because it basically is pulling forward a lot of selling into just today, instead of a nice orderly day after day decline, which is steady, and a steady decline of 3 to 4 point moves. You see anything above 3 points, you're above 1%. With volume at 100 and 125, we had volume at 200 off the charts. We had range at 9 points, almost double off the charts. And of course, the ATR to price was about 3%. I mean, that's an extreme move, and essentially pulls a lot of selling into here. And so it increases the probability, not to 100%, and that's not necessarily a high probability because of how low we close at the low. If we had to come up and formed a lower shadow here, we'd have felt a lot better. But even then, again, there's that March 23rd again. We didn't close at the low point there either. Now we traded around the range, the lower end of that range for a while before we bounced, and we had a little pullback again. But you can see, that on that day there was a 7-point move with the range, about double what was a pretty high ATR to begin with at that point. So again, there is a scenario where we can bounce off of here, and we've seen that scenario before because of how extreme the moves were today. That's what produces the scenario, is the extremity of this move. If it had been another day like these couple here, then that actually would have been more bearish in terms of still selling, taking longer time to get to a bottom. We basically got to the bottom in one day, and now have a lot of opportunity here, assuming you probably got stopped out of a lot of your trend trades at this point as you're breaking through some near-term lows. If that's the case, then those stop orders produce the cash you need to find opportunities to build into new positions if this low point ends up holding. Now, as I speak, there's tweets coming out talking about futures being down. Futures are a very low volume environment. How many times have you seen big moves in futures not able to sustain themselves by the time volume kicks in the next morning? especially even when Europe kicks in, right? So a big grain of salt on the current moves in the futures market and the likelihood of those moves sustaining and holding themselves by the time we hit 9:30 Eastern tomorrow morning. All right, so to summarize the technical picture of what happened today, of course, it was an extreme move. And the fact that it was so extreme is actually a good sign in terms of expectations for a bounce going forward. Had it been bigger than average, but not extreme, then the time frame of when we might find the bottom extends itself. But the fact that we had such an extreme move that we pulled in so many sellers and so much selling all at once increases the odds, especially with all the major indexes sitting at important support levels, increases the odds that we can bounce off of these lows. And we've seen that happen in a very similar technical environment, technical picture, earlier this year even. So we'll see if that scenario plays out the way that it played out last time as well. So what do you think of that? Agree or disagree? Love to hear the differences here. What you're seeing. Is there anything that we didn't look at that would give you the impression or suggestion that this support will most likely break? Are you seeing some other technical signs that are out there suggesting we'll continue this bloodbath into tomorrow? Make sure you share the comments down below what you're seeing, or some of you may not be. Maybe you expect that we won't bounce either. That we'll just kind of hang around here. So love to hear your thoughts and love to hear the back and forth. Share that down below in the comment section, either on YouTube or in the forums, Market Outlook forums on marketscholars.com. All right, now let's transition into what's driving this price action. Of course, if you listen to the headlines, the two biggest pain points right now, for the markets are tariffs and yields, 10-year yields. And you can see from an intraday standpoint, gold ended up of the day higher, the only asset class that ended the day higher. Some of these bonds, you can see the 7 and 10-year bond, the more intermediate rallied too. If you take a look at TLT, which is the 20 to 30-year bond, it actually fell today. So you did have gold, the dollar, and long-term bonds rallying. But look what also held up really well, relatively speaking, to some of these two equities and some of these other asset classes, and that's high-yield corporate bonds. So it wasn't broad, sell-off in terms of that standpoint. High-yield bonds actually held up and did relatively well, obviously, compared to what's going on in the equity space, right? In the corporate equity, with the S&P 500 dropping by far the most. Right, and there's IWM, so IWM outperforming S&P. You can see emerging markets lagging behind developed markets. If you take a look over at the foreign markets and how they performed, the S&P was actually up here for most of the day, and then that last kind of push when everything else was closed, so not as much selling in some of these other areas because they had already closed, their markets had closed overseas. The U.S. had made its run through the afternoon here and made its run to the downside. So if you look at the charts, the 12 grid for these 12 largest economies, global economies, you can see it doesn't look good from all sorts of perspectives. The S&P 500 is now close to its 3-month lows, really, really close. A little bit more left to go down. But you can see the UK, even with positive Brexit news, is at its 3-month lows. France is at its 3-month lows. Canada looks worse than even what we look. Germany is at 3-month lows, and South Korea is at 3-month lows. China is at 3-month lows. Japan has dropped below its moving average. Russia is close to its moving average. You can see Italy also at 3-month low points. Brazil is the one that's actually so far held up the best out of all of these, and India was already so far down. It didn't have as much to fall down. It was actually up for most of the day and finished with only a very small loss. So this was a broad base, and the interesting thing you hear, this talk about how, the administration viewed the weakness in the Chinese stock market, as a sign that the trade war is being won by the U.S. And then now you hear some chatter today about, well, this drop in the U.S. market should give the Chinese more leverage, right? By the same token. So whether you believe that or not, whether that's the main driver of these trade war, the back and forth in this trade war. The reality is, if you look at the 1-year picture of the S&P 500 and how much it's pulled back versus the 1-year picture of the Chinese stock market and how much it's pulled back, it's a much different story. So the Chinese stock market has lost 27% from its January high point when things were just going crazy, and that kind of at the peak of emerging markets relative strength versus the U.S. markets. The S&P 500 is down 3% from that January high. So it's a much, much different story than what you're seeing even with today's. And again, considering the extremity, the extreme moves that we see today and the likelihood of another move like that tomorrow is not 0%, but it's a low probability because we basically pulled all that selling just into today's move. All right, now let's take a look at the sectors and how they moved. And you can see utilities, staples, real estate, healthcare. So not surprising that those are your best performers, all outperforming. Materials with that small link to gold. Whereas on the other end of the spectrum, there's your 3 biggest laggards, which I've heard quite a bit of lately. Technology, communication services, and consumer discretionary, all really lagging behind significantly. You also see energy down with the drop in crude oil, and industrials down as well. But not surprising that those are your 3 biggest losers, and not surprising that those are your biggest winners, or your 3 biggest winners. Even with yields not really rising, right? Yield or falling. Yields didn't fall very much today. Bonds didn't take off today, especially long term. They actually were still down. So it wasn't, we didn't really flock to the most safety. But you can see here, and really during the last 5 days, if I were to go back, let's go back another week here. Here's during this pullback where the market's down 4.5%, and they're in black. You can see what's down quite a bit. Technology in red, not doing so well. You can't see the line for some reason, but you can see the sticker down here. Materials down quite a bit as well. Communication services and discretionary all lagging. Those are your biggest losers by far to the downside. And of course, there is healthcare here lagging or outperforming, energy outperforming, but you can see staples and real estate and utilities, all your biggest winners. So your safe havens holding up, your discretionary and technology pulling back, and that's a rotation that we've seen playing out a lot longer than just these last 5 days, right? The market has been shifting towards these safe haven areas and shifting towards other areas like energy and industrials for that matter, which is down a little bit more than the market, but has been shifting towards these areas previously, even before this pullback started, this 5-day pullback started. Go back to just today. So you can see, not surprising, and then when we bounce, if and when there will be a bounce, because there will be. In fact, if we were to go back to that March 23rd time frame, let's go back a little bit further. In fact, let's do this. Let's go to March. We'll go the whole week. So we'll go like the 16th through the 23rd of March. See if it'll allow us to keep on an intraday basis here. Give it a second to pull up. All right, here you can see utilities and real estate holding up. Discretionary and staples also outpacing the market. Materials, healthcare was down, financials, and technology. Those were your biggest losers heading into that day. And you can see technology down 8% during that week. Much bigger decline when the market was down 5.74%. Again, a bigger decline than what we saw right now. But if you take a look at what rallied coming off of that low point, and then there's a little bit more of a sell. I mean, we gapped up and then we pulled back early, and then we rallied on March the 26th, that next day. Technology, discretionary, you can see industrial and your safe havens lagging, still up but lagging behind. So we're going to get a similar move tomorrow, Friday. We've seen this picture before. We've seen how the markets now. What I'll say is, if and when we do bounce, and these areas that have been beaten up the most bounce up the most, you would expect them to bounce up the most. I do not expect them to continue to bounce going forward. Again, the sector rotation heading into the sell-off was coming out of discretionary and technology already. If you're looking at the sector selector tool that Brandon posts on our blog, that rotation's already been occurring. I expect that rotation to continue to occur even if we continue to bounce with discretionary technology lagging behind other areas like industrials and energy and things like that. If you see any kind of continued strength in commodities and weakness in the dollar. All right, so when you're looking for trade opportunities on a day like today, you can see there's going to be a lot of stocks that look like this. I mean, even Tiffany looked, a little down today already before coming in, but you can see there's other stocks that have been more bullish that are, coming down. UNP, UNH not down as much. Look at that chart, CF. Look at Deere. You can see these big pullbacks that you're getting in a lot of these stocks. There's going to be opportunities to look at a stock like Caterpillar or Tiffany for that matter and say, okay, do I want to buy the stock right now at 143 or do I want to lock in a buy price at 135? For $3.20, I can lock in a buy price by November expiration at 135. If it falls below 135, where there's going to be some strong support from volume in this area, then I'll buy that stock. I'll buy that stock at 135, even if you can see the low point at 134, 133. If we were to come down to that area, then that would be my buy price. I'd be buying it at the lows at 135, right there, right around that area. So I can say, okay, I don't want to buy here, but if it gets closer to support, I'll get paid $3.20 to wait and see. And if it does pull back below 135 and breaks support and does a little fake out and bounces back up, and that happens after November expiration, I can roll this option to December and wait and see when it does pull back, knowing there's a lot of support in this area to help it. So, and if I never get filled in, if we bounce off of here, then I get paid $3.20 again for my trouble, which ultimately ends up on a margin account on this particular account, getting about a 15% return until next November, while I wait to see if there's a better buy opportunity for this stock and if this support ends up holding. There's going to be a lot of opportunities when volatility is high and spikes and we get big extreme moves to the downside. Then that opens up the opportunities for short puts to sell on a lot of these stocks that have pulled back to extreme levels, that have pulled back to areas where you might be able to buy stocks at a price that you wouldn't have dreamed imaginable just a few months ago, right? We wouldn't have dreamed just a week or so ago that we'd be able to buy the stock at 135. We'd have to go all the way back over here and bought it over here. So if you missed that breakout, here's your renewed opportunity to get back in at those similar low points. So that does it for me today. Again, quite the day today. A day is similar. We've seen this before. We've seen these extreme moves occur over the course of a single day before. We've seen what happens afterwards before too. So are we going to follow that same pattern again with today's extreme moves? What do the probabilities suggest? I think there's a good chance that even if we don't bounce up and take out today's high anytime soon, that the low might be set in near these really strong support levels in a lot of these major indexes. Break these supports, things change. But until we break, we expect those supports to hold and for a low point to be formed, similar to what we've seen before. So what do you think? Now I'd love to hear your thoughts. I want to see the comments down below. What do you think? What are you thinking on a day like today? Has it changed your perspectives? Has it changed your rules on your investing plans that you're using to trade these markets? Tell me what you think. Were you prepared for a pullback, an intermediate pullback to occur? Maybe not to this extent, but what have you been looking for an intermediate pullback to occur on a lot of these major indexes? Tell me your thoughts down in the comment section below, or remember also on the Market Outlook forums on marketscholars.com, where you can share with other market scholars as well, some of our premium clients. And anyone who's subscribed, remember you can participate there in the forums for free. As always, thank you very much for watching tonight. Hope you got some value out of it. We'll be back on tomorrow. We'll see how the market responds to this extreme selling. and what happens and how that changes our expectations going forward. So stay tuned tomorrow and Friday. Remember to subscribe to our channel if you haven't already. Click that thumbs up icon down below, letting us know you want to see another video tomorrow, and then comment. Remember also to follow me on Twitter so you don't have to wait for these videos to get more content throughout the day. And remember, you can also join our Market Outlook community on Facebook. Have a great evening, everybody. We'll see you all tomorrow.